Do you want to avoid common investment mistakes and secure your financial future? Welcome to an enlightening discussion about the pitfalls that can throw you off your financial goals. Regardless of whether you're just dipping your toes into the investment world or you're a seasoned investor, understanding these common errors is key. It's like navigating a ship. Knowing where the rocks are hidden beneath the waves can save your voyage. So without further ado, let's delve into the top 10 investment errors that you should steer clear of. The first mistake is the lack of a clear goal. Imagine setting out on a journey without a destination. That's exactly what you're doing when you invest without specific objectives. Whether it's saving for retirement, funding an education, or buying a house, your goals should shape your investment strategy. Each goal may require a different approach, a different timeline, and different types of investments. Now, let's talk about the invisible enemy, inflation. It's like a termite, slowly but surely eroding your purchasing power over time. If your investment returns don't keep pace with inflation, you're not just standing still, you're going backward. In essence, you're losing money without even realizing it. Assets with potential for higher returns, such as stocks or real estate, are worth considering to combat this silent adversary. In conclusion, having a clear goal and being mindful of inflation are two fundamental pillars of a strong investment strategy. Ensure your investment returns outpace inflation and you're not essentially losing money. The third pitfall is failing to diversify. Imagine putting all your eggs in one basket and then dropping that basket. Not a pretty sight, right? That's essentially what you're doing when you pour all your investment capital into one asset class. By spreading your investments across a variety of asset classes, say stocks, bonds, real estate, or even alternative investments, you're essentially creating a financial safety net. If one asset class stumbles, you're not left flat on your face. Now, let's move on to the fourth mistake, overlooking costs. It's easy to get caught up in the potential profits of an investment and forget about the associated costs. But remember, every fee, every transaction cost, every expense ratio on mutual funds are all nibbling away at your potential earnings. It's like trying to fill a bucket with a hole in the bottom. Remember, every penny paid in fees is money not growing for your future. Chasing past performance is another common error. It's tempting to choose investments based on their track record, but remember, past performance is not a reliable indicator of future results. The investment landscape is dynamic, influenced by a myriad of factors from political shifts to market trends. Relying solely on historical returns can lead you down a path of disappointment. Instead, focus on thorough research and current projections to guide your decisions. Now, let's transition to another pitfall, emotional investing. It's natural to feel a roller coaster of emotions when dealing with money. But remember, investing is not a game of emotions. Emotional reactions can lead to impulsive decisions like buying when the market is peaking and selling when it dips. To counteract this, implement a disciplined investment strategy. Set clear rules for when to buy or sell based on rational criteria. Avoid emotional reactions that can lead to buying high and selling low. Your financial future will thank you. The seventh mistake is trying to time the market. It's a tantalizing idea. Buying low and selling high on a whim, reaping the rewards of perfect timing. But here's the hard truth. Even seasoned professionals struggle with market timing. It's incredibly difficult, if not impossible, to consistently predict market highs and lows. A more prudent approach is a long-term, consistent investment strategy. Moving on, let's discuss the eighth pitfall, underestimating risk. When it comes to investing, it's essential to assess the risks associated with different investments and ensure they align with your risk tolerance. Remember, as the potential for returns increases, so does the risk. You've probably heard the phrase, no risk, no reward. But let's rephrase that to, know your risk, know your reward. It's crucial to understand that high returns often come with high risks. So before you dive in, make sure you understand what you're getting into. Imagine stepping into a casino, blindfolded, and placing all your chips on a random number at the roulette table. Investing without doing your homework is akin to gambling. It's not just about picking stocks or assets that feel right or seem promising. It's about diving deep into financial statements, market analysis, and other tools that can help you thoroughly vet any investment before committing your funds. It's about understanding the ins and outs of the company or asset you're investing in, its past performance, its future prospects, and how it fits into the overall market landscape. And then there's the often overlooked step, rebalancing. Over time, some investments may grow faster than others, skewing your original asset allocation. Regularly rebalancing your portfolio back to your target allocation can help maintain your desired risk level and investment strategy. It's not just about growth, it's about sustainable and balanced growth. Remember, investing is a marathon, not a sprint. Avoiding these 10 investment mistakes will put you on a path toward more successful and secure investing. Remember, it's crucial to have clear goals, consider inflation, diversify, and mind the costs. Don't chase past performance or make emotional decisions. Avoid timing the market, underestimating risks, or neglecting research and rebalancing. Regular reviews and adjustments in response to market changes and personal circumstances are key. If you found this video helpful, don't forget to like and subscribe to Milo X World for more insightful content like this, and help protect your financial future.